Hi guys, thanks for tuning in to another episode of Nuggets News. Today we welcome a special guest who I've been trying to get on for a while, so I'm really pleased to have Joye with us. Thanks, Chris.
Thanks for having me on board, Alex. Apologies for not jumping aboard
That's
more
right,
quickly.
I know you're a busy man and you've got a great track record, particularly of late, which I wanted to dive into. Some things you definitely disagree with others on, a lot that we see eye to eye on, and some things that I want to sort of challenge today. So I'm really looking forward to getting into it. But maybe for those that haven't followed you, do you want to give us the rundown of sort of your background and everything you do?
I run Coolabah Capital. We are a fixed income fund manager. We run about 4.5 to 5 billion in assets. And I also write for the AFR.
Fantastic. Yeah, I love your articles. So, look, lately we've seen very interesting times in the Australian economy, the housing market, the coronavirus, and you were one of the people that got onto this fairly early. So from my point of view, we covered it from the health aspects back in January and thought that this was going to impact Australia in a big way, even if it was only in China because of our connection and our relationship. And then it obviously spread. But what were you looking at, and what were the sort of red flags that made you pay attention?
Yeah, so I think that for us, it was really an evidentiary question. So we were very data driven. And in January, obviously the Chinese told the world, I think on the 14th of Jan, that there was no sign of any human-to-human transmission. And the World Health Organization publicly reaffirmed that. And that was clearly a significant head fake. But I think it was reasonable to presume in January, given those statements, that containment was possible. We obviously didn't understand the full gravity of the crisis at that time. The Chinese, unfortunately, didn't shut down Wuhan until the 23rd of Jan. And then they kept their international borders open and porous, and millions of Chinese traveled throughout the world during Chinese New Year. But we have counterfactuals, Alex, now, because we've seen Taiwan, Hong Kong, countries like New Zealand and Australia very clearly contain outbreaks. Even South Korea have done a very good job of containing their outbreak. And I don't think the Chinese did do a good job. They had shut down Wuhan much earlier, and they'd been much more transparent about the reproduction rate of the virus. I think we could have contained it. So for us, we built data science systems that tracked all infections and fatalities globally, and ran a lot of analytics around the evolution of the virus. And we had a evidentiary basis for the view in mid-February that it was going to become a pandemic. I was, however, exercising concern. So we actually net sold 422 million of bonds in January. We built up our cash weights. In any levered portfolios, we delevered aggressively. In my market, there's a pretty a liquid asset class known as corporate bonds. We specialize in more liquid financial credit. And we sold all of our corporate bonds in January. And we didn't do a great deal. We were more or less neutrally positioned in February. But by mid-February, we felt we could conclude empirically this would go global. And that then led to the immediate realization that we felt that markets would not be able to price a pandemic and get outright market failures. And then that would precipitate very large liquidity and solvency crises. So in late February, we had this view. And I started communicating with the Prime Minister, the Treasurer, APRA and the RBA to basically inform them of that view. And we were arguing very strongly that we'd basically get the mother of all liquidity and solvency shocks. Now, that was something they could mitigate. And we argued that they needed to roll out locally and globally unrestricted liquidity support and QE operations and fiscal support from both central banks and treasuries. And I put this very forcefully to all the government agencies, the PM and the Treasurer, over and over again. I wrote about it in the AFR on the 28th of February, and we reiterated those views in early March. I guess the central banks of the world weren't convinced. And it comes back to this essential insight that I think was novel at the time that we had, that because of the unprecedented nature of a global pandemic that markets hadn't seen since 1918 in terms of a truly global pandemic, the information asymmetries would result in markets shutting down. And we saw that, Alex, in government bond markets, the worst liquidity ever recorded. So the US Treasury market was broken. The Aussie government bond market was broken. The German bond market was broken. And then that extended to much riskier asset classes. The US equity futures contract, the E-mini, liquidity evaporated. Corporate bond market liquidity disappeared. But this was preventable. And we thought the QE and liquidity bazookas would roll out in week 1 or 2 of March. As it transpired, the RBA started QE on the 19th of March. They did exactly what we recommended and expected. So, kudos to them. I think once the central banks understood the gravity of the crisis, they did move, but it just took them 3 to 5 weeks to get there. I mean, it's sobering also in this context to understand that we didn't see a US fiscal policy response until the 29th of March. Trump started March talking about a stimulus package of $2.5 billion, and he went to $2 trillion plus eventually. So there was a real disconnect between what we saw and what we thought was needed and the arrival of that policy response. And it was really the contagion and savage drawdowns in markets that ultimately forced policymakers to act. Nonetheless, over March, I spent about $800 million buying. In fact, over late February and March, we probably spent about $940 million buying at the wides in credit spreads. And we've since aggressively taken profits in April. So that's kind of, I guess, one set of perspectives. The other key insight for us was from our data science systems, Alex, we started building forecasting models. And those forecasting models really informed us in March that we felt that, well, the models told us that we would see a peak in the infection rates in the US, Europe, and Australia in early April. Now, at that time, the epidemiologists were arguing the peak was months away. And that advice was why the PM was saying, Scott Morrison was saying, we had to have a 6-month lockdown or a 6-month hibernation of businesses. And we thought that was totally wrong. We thought the peak would come in early April. And then once the curves flattened, we felt that politicians, being fairly mercenary, would be very focused on the economic costs of their containment. And we would see them quickly exiting containment in circa May. And that's kind of all more or less come to pass. So the peak in Australia was around the end of March. In the US, it was about 11 April. And most of Europe peaked in early April. So we've seen markets rally once we passed through that peak, which is what we had hypothesized in March would happen, which is why we spent $940 million buying assets. And we also thought that as economies normalized and we came out of containment, that would be a second regime change that supported market sentiment, which I think is also manifest. The risk to that view, Alex, is just the one thing I'm really worried about is US-China relations.
Yeah, I mean, you've touched on so many great points, Chris, that I do want to dig into already. So we have done a lot of education about the different markets, as you say, corporate bonds, junk bonds, and Chris is talking about those spreads. When the bid-ask gets really wide, if you can get filled, happy days, particularly if you can take profit a few weeks later, as you say. What I really want to talk about was why, market investors aren't health professionals. I think that's what was blatantly obvious when markets were charging higher. But we also sort of had that scenario where we got euphoria. We saw record numbers of, US retail users downloading Robinhood to buy Tesla shares and all that sort of nonsense as well. So it was like this kind of perfect mix of events that led to that sell-off and liquidity crisis, put call ratios. It was just the wrong time for this to happen, wasn't it? You talked about the liquidity, and this is where it gets really topical. So are you of the belief that it's do whatever you need to do, or some people are saying, well, why should some of these companies that have done all these, buybacks and whatnot, why should they get bailed out? So what are your thoughts around that?
Yeah, so this is a key intellectual issue that I sort of outlined to government in late February. And basically what I argued was that this is not an internally generated crisis. This is not what we call an endogenous shock. It was an exogenous shock. And, the words we used were, it's the financial equivalent to an asteroid strike. And in that case, it's not like you're worried about moral hazard necessarily. You're not worried about, bailing out bad bankers or subprime lenders, as was the case in 0809. This was really, notwithstanding, some folks who believe the Chinese, wittingly helped propagate the virus. The reality is this was a natural force majeure event, and there is absolutely a case in these truly external shocks for governments to act very quickly to ensure that businesses don't unnecessarily fail and workers don't unnecessarily lose their jobs. And I actually coined this term in my writings to the RBA, the PM and the Treasurer in February, of this idea of creating an economic and liquidity bridge to the availability of vaccines. And that was my proposition at that time, that you should create this policy bridge between now and when vaccines are available to allow workers to keep their jobs and businesses to survive. Now, having said that, as you probably know, mate, I've argued for 12 months that we've had a big increase in the share of zombie companies on the ASX. Zombie is a company that is paying all of its earnings, so 100% or more of its earnings, to service the interest on its debt. And we track this live. I can actually show you our zombie tracker if you want later. So we have basically, we've had since the GFC a rise of unprofitable levered companies, many of whom don't have a reason to exist. And one of the consequences of COVID-19 is it's unfortunately eliminating weaker members of our population, which is tragic, but it's also having a similar impact in the economy where it's killing off some of the zombies like Virgin Airlines.
Yeah.
We actually tried to get short Virgin Airlines bonds in early March. I borrowed the stock, but I couldn't find a bid. I should have worked harder to find that bid. It would have been an amazing trade, but
it is something we've covered in detail, particularly in the oil patch and the shale industry and whatnot as well. Do you think there's any danger of, back in 08 when they said these measures are emergency and temporary, and it was very hard for the Fed to taper, and I actually think that markets try and hold them hostage a little bit, and they sort of sell off and they get what they want. Do you think there's any danger of this alphabet soup of programs being very hard to unwind once again, and the emergency becoming the new normal?
Yes. I think there's every chance we could get a speculative melt up because we actually get too much stimulus. So if you go back to what we were talking about earlier, I said to the PM, we're going to see peak infections in early April. They're going to rapidly taper. The R0's going to fall much faster than you think. And we're going to be out of exit containment within 1 to 2 months. Now that's crucial because the PM had been advised by medical professionals and epidemiologists, and they were telling him he needed a 6-month lockdown. And because of that, the PM and the Treasurer had built the mother of all fiscal bailout packages. The Aussie fiscal stimulus is more than 10% of GDP, and is actually basically the most generous in the world. But that was sized for a depression. That was sized for basically shaving the economy for half a year. And it turns out the PM, to his great credit, he's crushed the curve, but he's also pivoted as we asked him to do. And he is now proposing to promptly relax restrictions in May. And I think you're going to see us come out of containment in May.
Yeah, I mean, I was a little bit critical early on just because I felt that if we had gone hard early, particularly with schools and hairdressers and stuff, I'm not going to complain because we're in a fantastic position, but I think we could have, really nailed that early and gone, gee whiz, if we, wear masks and do social distancing and whatnot, we can almost avoid having to go into that really wide lockdown. The thing that boggles my mind is what's happening in the US and Australia. If you're going to tell everyone they can't work, why on earth aren't you just injecting and paying their wages and keeping them going? We have these sort of two-step removed processes where, businesses, you've got to get a loan to bridge until we're going to repay you. All these companies don't have that revenue on hand to do that. A lot of people are sort of falling through the cracks with these different workers in industries and whatnot, whereas I think a couple of countries have actually just done the wage replacement or 80% of. What do you think about that? I mean, why not just make sure, if you're going to tell everyone they're not allowed to work, why are we letting people fall through the cracks?
Yeah, I think the first point would be, to your earlier question, that I think you'll see as we come out of containment, the government will prudently pare back the fiscal stimulus. So I think ScoMo is very focused on keeping the AAA rating, so Australia's sovereign credit rating. And it wouldn't surprise me if we saw JobKeeper pared back after the first 3 months, and the stimulus at large pared back, because it was calibrated for, again, a 6-month lockdown, and we're going to end up having a 1 to 2 month lockdown. But having said that, as you say, I mean, there's clearly details in the package that could be improved. And I think, to be honest, the government and the banks and the regulators are keen to do whatever they can. I mean, nobody wants to see businesses die and jobs lost because of a virus. And to the extent that the solutions can be redesigned, I think there's absolutely a preparedness and a willingness to look at some of those details. So, nobody's perfect, and this policy program came together on the fly, belatedly. I wanted them to do this in late February, but in mid-March, and I think they've done a very, very good job. But as you say, whether they should have run the wage subsidies through businesses or just paid them directly to people is an open question. And I'm sure the politicians would be happy to hear your feedback and try and leverage off your insights if you think that there's a better way to do business in this context.
Yeah, no, I don't envy them, and they have done a great job compared to other countries. I think Australia has even the technical ability to do so because of our system compared to the US that have a different tax system and payments and whatnot. But no, they've done a good job. We could be in a lot worse shape. How has your thoughts changed on the virus? Because I know initially that I was thinking, because the R0, we're going to have a lot of these rebounds and whatnot, but I think that it's maybe not as bad. We don't overload the healthcare system, because once you hit that point, the hospitals and whatnot, that's nasty. But I definitely think that it's probably more widespread through the community. Now it becomes about the antibody testing, but I think there's a lot less to be fearful of. As you say, it might only be this 1 or 2 month thing. Life will look different, masks and whatnot, but not as bad as we first thought.
Yeah, I mean, my view consistently has been from the get-go that once the world embraced social distancing and containment strategies, and we did think that in democratic societies there would not be much appetite for herd immunity. So the UK experimented with a little bit of herd immunity, but really most democratic countries, save Sweden, have gone for pretty firm lockdowns. And we've felt that with real-time digital information, the internet, and so on, that the dissemination of that information would result in massive synchronized global changes in behaviors. And those changes in behaviors would influence the R naught much more quickly than the epidemiologist assumed. And I think that's what's happened. I mean, the R naught looks like it's been below 1 in Australia for quite some time. I think we actually have a good chance of eradicating it. And I don't think we're going to get big second waves. I do think you'll see modest outbreaks here and there in countries like the US. But I think that the population has adjusted around the world. People are very worried about passing away and effectively the virus suffocating them, blood clots and losing legs, and most of us have relatives over the age of 65, and it's a very visceral human experience, and obviously an enormous tragedy. So I think most people, 90% plus of the population, are responsibly trying to mitigate through permanently adjusting social behaviours. I think the remote working experience has been quite successful, and I think there's a very, very good chance, particularly as we move into the northern summer, that we'll see infection rates tail off quite dramatically, in concert with, I think, a universal acceptance that we need to rapidly increase testing and tracing. So, everyone criticised the government for being behind the curve on testing. We track testing live. I might actually try and show you this screen right now.
Yeah, bring that up for us, Chris. What I was going to say is I think that we're going to have this universal treatment of azithromycin, hydroxychloroquine, maybe some vitamin C, zincs. Even if it takes 12 months to get that vaccine, I think that there's a lot more that we can be confident we can keep it sort of contained. But we are getting that new evidence now that it may be more of a blood sort of disease rather than just the lungs. So I guess that's what sort of still has me a bit cautious, that there's still so much we don't know, and particularly the reinfection and the immunity is going to be a big pivot point.
I completely agree, Alex. I think so. On that point, I think there are big known unknowns. The first is the antibodies and the immunity. Now, how strong is it? The second is, will we get vaccines, and how durable will they be? I guess the third is mutations. A fourth is the antivirals. So remdesivir and hydroxychloroquine. Our view on all those things are, our central case is that we will get immunity. We've always maintained since February that vaccines will come much faster than we think. One of my analysts, his father is a guy called Professor Michael Good, and he is one of the world's top biologists, and he is leading one of the teams working on a coronavirus vaccine. And I think we've argued since February, you'll see tractable antiviral drugs, and it does look like remdesivir is quite effective. I know there's kind of a bit of debate there. The Chinese study, quote unquote, sort of arrived at diametrically opposed conclusions to the US study, but frankly, I believe the US data. Just looking at this screen though, mate, like on the testing, this is our internal data science system, where we can add any country in the world. So I can bring up Sweden here. And the systems, they update live, and we have a bunch of different diagnostics that we can look at. The system's just running right now. And so this is cumulative infections, the rate of change in infections, deaths recovered, and so on. Here we track live mortality rates. All this data is dynamic, updated every 15 months. We can change the day lags on mortality rates. We can zoom in and look at specific mortality rates around the world. Here we have the growth trajectories in logarithmic terms. So little Australia's down here. We're doing very well. We've flattened our curve. This is Hong Kong, New Zealand. You asked about India here, the US up here. But on testing, we also actually, interestingly, take death data around the world And then we take the age population pyramids of each country, and we use South Korea as a baseline for true fatality rates. And we estimate how much countries are underestimating infections. So to zoom in here, so right now, in Indonesia, we think the infection rate is 31 times higher than what Indonesia is claiming, if that makes sense. In India, it's 16.4 times higher, and so on. And then in testing regimes, we can look at tests per day. So that's the US ramping up their testing to about 250,000 tests a day. But then we can look at tests per capita. And number one is New Zealand, followed by Italy, then Australia. And the US is actually doing a good job here of coming up the curve.
Okay. Fantastic.
Yeah,
cool. I guess the next thing I do want to move on to now is probably more about the Australian economy and those second order effects. So we touched on like corporate real estate and that sort of thing, the working from home that you mentioned. Do you think that is going to be something that does put a strain on those commercial real estate values? Because I know I want to dig into your property forecast in a second, but let's just commercial.
Yeah, I'm very negative on commercial. I think, firstly, commercial property prices aren't measured using sales values normally. They use appraisals. So these are valuers. And it's well known that there is huge inertia in commercial property valuations. They often ignore distressed sales. And I think right now in portfolios in Australia, commercial property is likely materially overvalued. I think there's going to be a significant reduction in commercial property rents. I think there's going to be a significant reduction in demand generally. And I think you're going to see a big correction in prices. For office, particularly office, because this synchronized sort of global remote working experiment is going to force a lot of SMEs, I think, to disaggregate and try and work more and more from home. And equally, the digitization of consumption will see, I think, a diminution in demand for physical retail. So I'd be trying to get short if I was a equity investor, looking at getting short office and retail REITs. To be clear, I can't provide personal financial advice, and that is just my own view. I'm also very negative on the bonds issued by these companies because the commercial properties have issued debt in the public markets, and they've had this huge revenue shock. A lot of people aren't paying rent, but at the same time, they can't get interest repayment holidays because they haven't borrowed from the banks. They've borrowed from investors like myself. To be clear, we don't invest in any commercial property bonds or REIT bonds. In fact, we have never invested in a single REIT bond. Most fixed income funds, however, do. So I'm very negative commercial.
Yep. I think a few other trends, as you say, that are going to be accelerated. We've seen 3D printing, like kids at home helping hospitals print masks. I think 3D printing is going to accelerate, and a few other little things here and there. But yeah, the reasons to drive to work and work in the city and pay high rents are just not really there anymore. Let's get into your housing forecast, because this is where we've had the property market starting to roll over. We had the election, had a really strong rebound. Interest rates have been dropped quite aggressively. So I want to get your thoughts about how you get to your forecast of very little downside and likely, a lot of upside in this cycle.
Yeah, okay. I might just, in that spirit, mate, just pull up the live house price data. So we can use the CoreLogic National House Price Index here. So 1 second, right. I'm just going
to... I did see that they weren't going to be doing that day to day because that wasn't enough data or whatnot, but they're still doing that day to day, are they? Okay.
Yeah, absolutely. 1 second. So if I screen share. Yeah, so this is the 5 capital city index. And we go back through time. So that's the index since 2016. So we were basically very public in saying we thought national house prices would rise very strongly between 2012 and 16. In fact, through to the start of 2017. In April 17, I said the boom's over, prices will fall 10%. At that time, there were no analysts in the market that had negative views on housing that I know of. To be clear, mainstream analysts, not kind of perma bears like Steve Keen. And so prices were still rising in April 17, but they rolled over quickly thereafter. National prices fell 11%. And then in April 2019, when prices were still falling, I wrote in the AFR that I thought there'd be a big turnaround and prices would rise 10% nationally over the next 12 months. And that's exactly what happened. They basically bottomed a few months later, and then we had obviously this big increase in prices. CoreLogic's numbers have come out today, and they are reporting that over the last 12 months, prices have indeed increased across the capital cities by 9.7%. So that was in line with our projections. If we look at what's happened recently, this is the last 6 months. So this is the 5 capital city index. And what you can see is that, I'm just going to get a month. Oh, okay, daily data will do. Sorry. That's probably a better way of looking at it. So prices rose through February, March, and have started to flatline in April. National prices actually increased by 0.3% in April. Since I think February, I've been arguing that I expect prices to flatline or possibly fall by up to 5% over the next 6 months. But I think because we're going to come out of containment quickly, and because I think the economy will bounce back much more rapidly than folks think, I think this boom will continue. So I'm expecting capital gains of 20 to 30% throughout the totality of this cycle. And that's based on a quant model the RBA uses for the Aussie housing market. And it estimates that, I think in early 2019, every 1% reduction in mortgage rates would drive a 28% increase in national house prices. And that's basically what we've had. We've had about a 75 to 150 basis point reduction in mortgage rates. And since mid-2019, across variable and fixed rates, we've had 10% capital growth. So I still think we've got another 10 to 20% to come. But I think this little air pocket you're seeing here will continue. I guess I started arguing this in February that we would see growth start to flatline, possibly fall by up to 5%. But I don't think everyone else, as you know, Alex, every man and their dog thinks I'm wrong. So, CBA saying 10 to 20%, AMP saying prices will fall 20%. Louis Christopher, who's a very knowledgeable guy who I respect, thinks prices will fall by 30%. So I'm not like ultra high conviction on this. We haven't seen this sort of crisis before. So it's actually very hard to model it. But I have been asked a question and that's my response. As far, the data is absolutely, we're not seeing prices tank at all. If you look at Sydney prices, I'll just bring those up. It is the same story. You're seeing the daily hedonic CoreLogic index at RP data, or CoreLogic as they're now known, publish. In Sydney, prices rose through February. They rose in March. They've started to flatline a bit. They still increased in April, but they look like they're flatlining. In Brisbane,
we do have a range of guests on, and as you say, a lot of them are pretty bearish, and it's actually a bit of a surprise to me that the banks came out with such bearish forecasts. But I guess longer term, I'm just wondering, interest rates are almost at that zero bound now compared to where they've been. Even over the generations where we've had two people working, where we used to have one, can house prices still see that that big growth because they've had all these tailwinds, and now more recently we're going to have the less immigration, tourists, education, hasn't been the wage growth. Are all those things obviously factored into your opinion, so they're not enough to not cause their houses to still go up?
Well, I think there are, as you say, there's countervailing forces. We've got a temporary pause in immigration and student migration. We have obviously very weak growth right now. We've had a big increase in the unemployment rate. But I think all roads lead to this question of how quickly do we see a convergence back to this new normal. So I think if we can get the economy back online in May, June, and activity normalised, I think the jobless rate will come back to, assuming it kind of pops up to about 10, I think it'll level out and stabilise around the sort of 6 area, maybe 6 to 7. And I think you've also had a massive reduction in mortgage rates, where now you can get circa 2% home loans fixed for 3 years. And assuming there isn't a huge negative shock to incomes, clearly incomes are being supported right now through the government's Job Start and JobKeeper programs and this massive fiscal stimulus. So as long as incomes for businesses and households are supported, and we can get that economic engine revved back up again, and growth expanding in May, June, I expect the housing cycle to reassert itself. I think one of the reasons housing is likely to be very resilient, there's 2 key reasons. First, I don't think you're going to see much forced selling. The banks have disclosed that they've given, ANZ and NAB have given between 7 and I think 14%, or by number between 7 and 10% of their resi mortgage borrowers 6-month repayment holidays. And what you'll see, I'll actually share this screen. What you'll see is a big decline in activity, and that's what always happens in these scenarios. Okay, you've got it up here. So this is the CoreLogic press release from today, and I'm just going to zoom out a bit here. So, Alex, you can see a huge reduction in sales volumes, and this always happens during downturns. And you're also seeing a massive reduction in listings. That's super important, because if there were waves of distressed sellers, people defaulting, banks foreclosing, you'd expect these listing numbers to increase, but you're not getting that. And you've got a huge reduction in effective supply, which will offset or heavily neutralize the reduction in demand. And we know that, as a share of household income, households today are only paying about 6.4% of their income to service interest repayments, which is quite low. It's actually less than that. It's probably about 5 point something given the recent mortgage rate reductions. That's as at December 2019. And that's quite low relative to what we've seen. In 2007, they were paying about 10.5% of their income to service interest repayments. And we're back at circa 2003 levels. So I think that there's still a lot of purchasing power. Now, I could be wrong if we have a massive global recession that kind of continues for years. This central case of ours would be wrong if we get a huge second wave globally, if there are no vaccines, if all of our assumptions around that base case are invalidated. Yeah, sure, we could get easily a 10, 20, 30, 40% drop in house prices. There's no doubt about that. But at this point in time, I think resi will be resilient. One of the reasons it will be resilient is precisely also because of the price action. When this is Brisbane house prices, people who own homes have seen in February, Aussie shares were down 8%, but house prices were rising. In March, Aussie share prices were down 21%, but home values were increasing. similarly in April. So I think if savers look at bank deposits, they're not earning really any interest. If they look at super, they've got negative returns. And for better or worse, Resi, they've had capital gains over February, March, April. In fact, it's actually interesting. If you look at what happened in April, this is the CoreLogic data. These are the monthly capital gains. I mean, every city was up except for Melbourne and Hobart. Now, I do think it'll be soggy, and I do think prices will flatline. I have said I think they could fall by up to 5%. But compared to every other analyst and forecaster in the market, I'm sticking out there like a bull's balls right now. I'm much more bullish than the consensus.
Yeah, I just wonder, is that part of the melt-up scenario? If we get, let's say, the full 20%, average Sydney home price is 1.2 million, and we're sort of back to that 10 income to house ratio, have investors changed their mindset a little bit with what's happened, where they're going to sell that investment property? A boomer's going to look to hedge their risk? Is there going to be forced selling from, even today, we mentioned that pre-interview, those property trusts holding a lot of these illiquid assets, these guys that have got 20 Airbnbs that aren't filling them up. I just wonder if that's going to play out in the next few weeks, and that's going to change the story a little bit.
Well, if you look at the rental yields on Resi property right now, you can see this table here, mate. Yeah, I'll zoom in. So this is again the latest data. But, for dwellings, apartments this is Sydney, Melbourne, Brisbane, your gross yield is 3.445%. I think those yields, combined with the fact that prices are stable and have been increasing, that's pretty attractive relative to equities, which are, have been off as much as 30%. Commercial property, which is in free fall. Yes, I think there will be some stress in the rental market. In the same way, there'll be a bit of stress in terms of prices, and you'll get that sogginess that I've referred to. But I think relative to every other asset class, I don't see mums and dads selling their winners and buying their losers, if that's what you're suggesting. I think they're going to ride their winners, and their winner thus far has been Resi, and emphatically so. I mean, Resi's been the single best performing asset class this year, you would argue. I mean, just off the top of my head. I mean, I'm sure maybe you'll say gold and other asset classes have done better, but last 12 months, and I don't know if they've got the year-to-date numbers. They don't.
Yeah.
But we can see, Resi since January has been heading in one direction. Again, I'm not saying that I think it will flatline / fall modestly over the next 3 to 6 months, but I think after that, the boom will continue. I'm pretty high conviction on that boom continuing. I'm not so high conviction on what precisely prices will do during this unprecedented air pocket. But I think it's good news for Resi investors that they've got 3 month to 6 month repayment holidays from banks. And all that'll happen is that when people get their jobs back, banks will just extend the loan terms and therefore increase the amortization schedules. So hopefully we won't see a repayment shock. Rather than having a 30-year loan, you'll have like a, say, 35-year loan, and your repayments will be what they were before, notwithstanding you actually have high levels of debt.
Yeah, I think that repayment holiday, as you say, was very, very bullish, and that saved a lot of possible damages and whatnot. Things could have got messy without all that. But there is still landlords and tenants working all that out at the moment. So I do want to change gears a little bit and talk more broadly about the Australian economy and your thoughts on that. We did a documentary a year ago and just spoke about the things like economic complexity, our tax rates globally aren't that competitive. Do you think that Australia has got a very, very bright future, or are we becoming less globally competitive on that stage at the moment?
No, I think we're definitely becoming less competitive globally. And despite, the Wonder Down Under's extraordinary luck, We haven't had a recession since 91. We've got these amazing endowments of natural resources. Iron ore prices remain incredibly high. But I think there is an essential Australian entrepreneurship and ingenuity that has served us well for a long time. So if you look at the way Australia's handled COVID-19, I think that's testament to the adaptability and resilience of the country in acting quickly and responsibly and trying to mitigate that threat. So it's a little bit like America. I think one of the essential sources of both Australian and American prosperity has been the fact that we're two great multicultural countries. Australia has, as a share of its population, or is basically the most multicultural country in the OECD. So roughly 30% of us who live here weren't born here, and roughly half of us have a parent who's born overseas. And if you look at the great wealth creators over the last 100 years in this country, they tend to have been highly motivated, hardworking, first or second generation migrants. And I think you'll see that migration, notwithstanding the temporary 12-month pause, I think you'll see that come back online with gusto. In fact, if you think about how this is going to play out, Australia and New Zealand are going to really attract, I think, a premium as incredibly safe and politically stable and economically prosperous destinations for high quality human capital from around the world. If you have your choice now and you're a super talented Chinese graduate, where would you go? Australia, New Zealand, or China, or the UK, or Europe? I think we kind of really stand right now head and shoulders above the rest of the world. If you take sort of all amenities into consideration, so health, quality of life, and our economy. So we saw this in the Asian crisis in the late 1990s. Our biggest trading partners were India, South Korea, China, and Japan. Everyone thought Australia would be fucked, excuse my French, and that our export markets would be decimated. But our exporters displayed tremendous agility in substituting to other markets. And I think you'll see the sort of same story with tourism and travel here. I think you'll see that domestic tourism will actually be fine as Australians shift away from consuming offshore tourism, that is traveling overseas, to staycations. So I'm a positive person insofar as I tend to see solutions to problems. I think a lot of people, Alex, are great at talking about problems.
100%.
All those guys in February who were saying this is the end of the world, said, a lot of, I think, bears were saying most of us will get infected with COVID-19. Well, as it turns out, that's just not true. Even in New York, only 20% of people have been infected. As it turns out, in Australia, it's likely that most of us won't be infected. And that's true of in places like New Zealand, Taiwan, Hong Kong, and hopefully Japan and Singapore. So I think the Aussie economy has strengths and weaknesses. I think our resources endowments are a strength but a weakness because they engender complacency. I think Australians' egalitarianism and willingness to question the status quo and reject authority and conventional wisdom is a source of great innovation. But on the other hand, Australian conviction and confidence can be a source of hubris. So coming out of the GFC, Australians were way too confident about our domestic experience. I don't think that was much to do with skill. I argued at the time it was everything to do with luck. I argued that our bankers weren't any smarter than bankers overseas. They were just bloody lucky for a whole bunch of complex reasons. But the good news is we spent the last decade bashing up our banks, de-levering our banks, and crucially de-risking their business models. So when we came into this crisis, CBA was levered 21 times in 2007. And today it's levered 8 times. So you have this profound deleveraging. Similarly, ANZ had massive exposures to Asia. And I had this big battle with Mike Smith, the former CEO, for the last 10 years, basically saying, you got to get out of Asia. It's going to increase risk with very questionable returns. And they did that. Unfortunately, in their results released this week, their single biggest impairment is one of their residual Asian holdings. But yeah, I think we've actually been pretty well prepared for this crisis. And I think the prospects for the economy are okay. I don't think they're amazing. But equally, I'm not kind of crazy negative on the path that lies ahead.
I actually really agree with that point about the premium being attracted in Australia and New Zealand. I'm down in Tasmania, Chris, and it's the best kept secret. I don't want more people to find out about it. I think it's really undervalued, the property and the lifestyle, with the boomers looking to retire and that safe haven status, all that sort of thing as well. That's a bit of a Tasmania show.
I've stayed at Sapphire down there, and Tassie's a beautiful place, and Tassie could do a much better job, frankly, as exporting itself to the rest of the world as an alternative, like in the same way New Zealand has done. So New Zealand's had great success over the last 10 years, attracting a lot of capital from offshore. A lot of the top hedge fund investors around the world have invested in New Zealand. I think, doesn't Elon Musk have dual citizenship?
I'm not sure about that one. That's interesting.
I think he has, unless I'm mistaken, I think, let's just Google that.
While you're Googling that, Chris, I do want to talk about that, the central bank actions and the liquidity bridge and whatnot. Do you think that there's this risk of, the Occupy Wall Streets and that happened, that it's seen, or it actually does result in more inequality and that sort of thing going forward? Is that kind of the breaking point? We've seen it a lot in some of these other countries where the financial system's breaking down. Not really a risk in Australia or the US or whatnot. But do you think people are worried about that?
Yeah, not so much this crisis. I think this crisis has really been about Team Australia. Like if 0809 was about bailing out banks, 2020 has been about the banks bailing out businesses and the banks bailing out households with those huge repayment holidays. So I'm not too worried about inequality. What I am really worried about is geopolitical frictions. I'm very, very worried about, and we've seen this in the last 24 hours, and I've written about this over the last month, that Trump will use this as an excuse to engage in really vitriolic, xenophobic bashing of China in the lead up to the November election. Biden is considered to be a dove on China. And I think Trump is going to try and wedge him on his Chinese sympathies. And, the truth is the Chinese have handled this terribly. And, it is plausible that apparently the virus was not necessarily man-made, but did originate from those biolabs in Wuhan. And I think, we could see some policy-making errors. We could see, the US are talking about cancelling the Chinese holdings of US treasuries. They're talking about reparations. They're talking about suing China in international courts. So, or at least other countries are. And I think that could create a lot of destabilization in markets. Like right now, Aussie equities are off. Last time I looked, Aussie equities were off, 3.5%, and that's on the basis of partly some pretty bolshy comments from Trump apropos China. Overnight, US equity futures are down 1.3%. So that's my biggest fear. I think the coronavirus has actually been a unifying and solidarity-inducing event for communities. I think we've really come together. We feel like we're in this together. And I saw, I was speaking to the major bank CEOs almost every day through late February and through to mid-March. And the way that they work together with APRA, ASIC, the RBA, the Prime Minister and the Treasurer was extremely impressive. And they were really sincerely focused on how can we save jobs and save businesses.
Yeah, so, no, I think that's great. We have done really well as a country. When you look at Lebanon and some of the other places that's going on, we forget how lucky we are a lot of the time. Final thing just to talk about now, going forward in terms of the financial system, you mentioned that China might be selling their US treasuries. There becomes that sort of financial warfare and playground. The Fed have stepped in. They don't want to see rates rise. Is the US that sort of final battleground for the world reserve currency? Is that as big a deal as people make it out to be? You know, if the US ends up going negative and their bonds get to zero, it's far less attractive. We're seeing a lot of people trying to talk about a new fairer system. You know, even Bank of England coming out and saying US got too many privileges. They get to print trillions and there's still this huge external demand for the euro dollar and whatnot. Is that a big battleground, or that's not something that you really think about too much?
Okay, let me answer that a different way. I'm often asked, are we going to get big sovereign debt crises from COVID-19? So obviously we end up with a world with more debt, more private debt, more public debt. We're seeing unprecedented volumes of government bond issuance around the world. That needs to be bought and funded. And if investors don't want to buy those bonds, you could get big increases in sovereign spreads or interest rates. And yes, countries could default on that debt. My view on that, however, is that the central banks of the world will do what they're doing right now, which is buy those bonds and fund those public deficits. That's the easy option. That's what QE is. At the limit, they could be the only buyer of those bonds. We've seen that the Bank of Japan owns more than 50% of the Japanese government bond market. And I think you're going to see that trend continue around the world. We've seen some perturbations in the Italian government bond market recently, and the ECB is under more and more pressure to buy more and more of those securities. So I think that's where we're heading. And the only reason we can do that with almost no constraint, that is, central banks can literally just print cash and then take that cash and use it to buy bonds, is because nobody's worried about inflation. So I think the financial battleground for me is that all roads ultimately lead to a big inflationary cycle, because it's so convenient and so easy just to print money and buy stuff to solve problems. And that's been the policy-making reflex in 08-09, in 11-12, in the first Eurozone sovereign crisis, in 15-16, in the second Eurozone sovereign crisis, in 2018, and now in 2020. And so unconventional monetary policy is becoming conventional. And I just think we're going to see more and more of it. And what that will mean is ultimately you debase currencies. If you helicopter money, if we give every Australian $1 million, what's going to happen? They're all going to buy houses, but you're going to get huge inflation.
Yeah.
And I think that's when, at that point in time, people start saying, well, what are the more credible stores of wealth, the more credible mediums of exchange? And that's where you probably start looking at alternatives like gold or digital currencies.
I know you said that just because you're on the channel, Chris, to keep everyone happy.
It's true, mate. And I said to you offline, I don't have a view on what those hedges are necessarily.
Yeah.
But I think the debate over the next 10 to 20 years ineluctably, inevitably, irreversibly sort of converges towards alternatives.
Yeah, I think was something that just went under the radar a few weeks ago was the New Zealand governor from central bank come out and just said, we are going to directly monetize the debt. Like, let's stop mucking around here. And then you've got Trump that's kind of got his hands on the money printer a little bit now, and a couple of trillion here going into an election. It's this big question. I know you're saying, I know you and Steve Keen have your debates, but even Steve's point about, well, who actually creates money? Is it banks? You know, a government's just going to go MMT style. Central banks, they want their power. They want to keep printing and feel important. So this is where we're at the sort of the forefront, where we're seeing really smart people like you start to join these dots and say, well, not yet. I'm not that interested, but yeah, it actually makes sense. You know, Bitcoin's something that's digital and scarce or whatever it is. There is a path sort of forward there, and these questions have to be discussed.
So I don't know, Alex, if Bitcoin's the answer. I'm not qualified to express an opinion on that. I'm not an expert on any of those subjects. So I kind of don't. It's like, climate change. I don't talk about climate change because I'm not an expert. What I will say is my central case is that ultimately we're going to get more and more money printing. It's super easy for the policymakers to print cash and buy stuff and solve all problems under the sun. And that ultimately has to debase the value of currencies. And when you debase the value of currencies, you're to get more consumer price inflation. We've seen clearly a huge amount of asset price inflation, which will continue. And the only thing that can stop this, the circuit breaker, is inflation, specifically consumer price inflation. But I remember talking to the RBA only a few months ago, and they said no one in the world, quote unquote, is worried about inflation. So right now there's no cost to money printing. So I think it heads towards MMT. I think, I could see central banks, printing multi-trillion-dollar coins and flipping them to the Treasury and saying, there, go and pay back all your debt.
Yeah, does that, sorry, Chris, I didn't mean to put words in your mouth. I'll promise I won't make the title of the video, Chris Joye says buy Bitcoin. But I completely agree with what you're saying there. And I think this time around, it is more targeted at the actual real economy than just the banks and getting liquidity stores up like in 08 that didn't result in any inflation when a lot of the gold bugs thought that it was going to happen. So that's the path forward. I think I agree with the MMT stuff. Any final thoughts of people? It's been great. We've got through everything I wanted to chat about. I love picking your brain. But any final thoughts of people at home about Australia, the economy, investing in general?
I mean, I've just been very leery on corporate bonds. So I like bank bonds. I like bonds issued by government guaranteed banks that are never going to be allowed to fail. That are historically very cheap, and that's what we've been buying and selling. We sold our corporate bonds in January. We only own two, a Coles bond and a SEEK bond. And I've been arguing since last year that the high yield bond market is a huge source of risk. And last year I kind of went on the warpath trying to highlight this. You had a surge in these listed investment trusts or LITs, so high yield bond funds listing on the ASX. And initially they all did well. And I said, listen, in any stress scenario, you're going to see these high yield LITs get absolutely smashed and trade at massive discounts to their net tangible assets. So I can actually show you. So an example would be like, KKR listed one for 925 million.
Well, I was just going to say on that, like the Fed stepping in, what we said about before, inequality and whatnot, is that too far when the Fed step in and get BlackRock to start buying HYG and LQD and that sort of thing? Is that needed? Is that fair in your mind?
I'll come back to that point, but this is an example of a high yield LIT issued by KKR in November. They raised 925 million. So through this period, I was writing that high yield bonds are a huge source of risk, and particularly on the ASX, where you've got funds investing in liquid high yield securities. There's a real risk they trade at a massive discount and get smashed. And of course, it was trading at 250. NTA was 250, and then it fell down to 125, and it's still at 169. And if you look at NTA, last reported NTA here, according to Bloomberg, was 255. So massive discount. And you saw that similarly with here's another one. This is another high yield bond fund listed on the ASX. Same story, was trading around 205 consistently. And then this is NBIAU or NBI ASX, Neuberger Berman's product, and it traded down to amazingly 93 cents. It staged a bit of a significant rebound. It's now at 170. And I'm not sure if they report their NTA. Yeah, here. So you can see it was actually trading, the white line is the price and the blue line is NTA. And it was trading above NTA all the way through here, and then it got smashed down to 117 versus 152 NTA, and now there's a smaller gap there. So your question is, should the Fed be buying high yield bonds? What the Fed is doing, and this is something I did not expect them to do. Like in late February, I was advising the central banks to unleash the QE dogs of war, to fire the QE bazookas. But I didn't think the Fed would buy high yield bonds. They are actually buying bonds that were investment grade in March, but have since been downgraded to high yield because of the virus. So it's a fairly limited program in that respect. I don't have a huge problem with them doing that because they were companies that were good, allegedly, that have become bad because of this, pathogenic pandemic. The other thing they are doing is they're buying corporate bond ETFs. I actually run an ETF on the ASX, HBRD, which you can see here, for beta shares. This invests in hybrids and bonds. We also were smashed down in the March period, but as you can see, there's been an extremely strong rebound. Crucially, you can also see we always traded at NTA, so the blue and white lines, in contrast to those high yield bond LITs, the blue and white lines here track each other, so there's no big disconnect, and that's because we hold liquid assets. High yield bond funds hold illiquid assets, and when you have illiquidity, basically investors can want to get out, and that's when you get a situation like this, where you basically see this big disconnect between the NAV and the price, or the NTA and the price. The other thing that the Fed is doing here, so it's buying high yield ETFs, investment grade ETFs. It has said that it will also buy high yield ETFs. I think that's a step too far. They're basically buying zombie companies, subprime corporate businesses, and I think that that's probably a step too far. I mean, the Fed buying subprime bonds, but they did do the same thing in the GFC. And it is an extension of the logic that I've articulated in terms of providing that economic and liquidity bridge until vaccines to businesses that would otherwise survive. I'm just somewhat surprised the Fed's gone that far. And that will certainly help mitigate some of the downside risk for high yield. But I think my big concern, mate, is, generally speaking, governments of the world are focusing on protecting systematically important businesses like banks. They're focused on saving workers' jobs, and they're focused on SMEs. They're focused on Main Street. There is a big middle market, the mid-market, where you're not too big to fail as a business and you're not too small to matter to politicians. So Virgin Airlines is a classic case in point. And I think you'll see a lot of business failures in that mid-market, which is a real source of risk.
Yeah, last question, bonus for people that have watched to the end. And I know you probably know Phil Lowe reasonably well. I sort of get this impression, we've got a real interesting relationship between Trump and Powell, and Trump's kind of got his way in the end. I get this feeling that Phil Lowe's almost too nice a guy in terms of he's not aggressive with his monetary policy. These other guys come out with these big cannons, and the RBA have been a little bit later to cut than others. They've already sort of talked about tapering their QE, and the Aussie dollar is sort of strengthening. And I see that the market's starting to price in, well, Phil Lowe's not the sort of guy that's going to come out with this big bazooka and even use that language, because forward guidance is so important these days. But do you think he's less aggressive than a lot of these other central bankers that are just saying whatever it takes at every sort of policy meeting?
Listen, I've been a long-time critic of Phil Lowe's, but I think he's been magnificent since he understood the magnitude of the problem. So he disagreed with me in early March and late February. The RBA didn't think there was a liquidity crisis. They didn't think there was anything really to see. But they came to the party on the 19th of March. And I think he's been really smart. He's worried about what you said earlier, I think, which is this slippery slope, that if you just start buying everything under the sun, you will never be able to stop. And then the market basically needs you to be there forever with that put option. And he's been very careful, saying we'll buy some government bonds, but we're going to be very limited in what we do. We'll lend to banks on, at basically zero interest rates or near zero interest rates for extended periods, and we'll make sure the banks don't suffer from huge increases in funding costs that they would then have to pass on to borrowers, and therefore increasing home loan rates and business borrowing rates, which would only amplify the recession. So I think that makes perfect sense. He said, I think it's great that the Treasury is buying bonds issued by lenders that are asset-backed, which was another proposal I'd put to the government. But he has said, we don't want to take credit risk. So it's been pretty clear that they're not going to buy corporate bonds or high yield. So you could say that he hasn't been as aggressive as the Fed, but equally, I don't think he's had as big a problem. And I think, the RBA has been always, characteristically conservative and cautious. And that's not a bad thing, mate.
No, I'm not saying it's a bad thing. I'm saying that the market now, the rest of the world is so used to this just over the top, over aggressive policies and this cheerleading. Yeah.
Mate, you're 100% right. Like, trust me, most investors are saying the opposite of what I've just said. A lot of investors I speak to are saying, Phil Lowe and the RBA are pussies. They should be buying corporate bonds and buying high yield and providing liquidity facilities to super funds, but they've said no to all of that. I respect them for that.
I completely agree. That's going to save Australia in the long run, but it's very hard to go against the market. And I just wonder, like, I thought Powell was going to be his own man and when he initially got elected, but he did that U-turn. Anyway, mate, that's been fantastic. You've given us a lot of your time very generously. I thank you for that. I'll put the links to follow you in the description below. Any final thoughts for people at home?
No. I appreciate the opportunity, mate. It's been great to engage with you guys. And hopefully you've got a bit of an insight into the way we think and the way we've tried to understand this, 1 in 100 year shock. As I said to you, in summary, we net sold 422 million of bonds in January. We were neutral in February. We net bought about 940 million over March, mostly March and a little bit in late February. We've net sold probably about 400 million in April. And, I think we were one of the earliest to call the early April peak in infections and the rapid exit from containment. And likewise, the market failures that would propagate liquidity and solvency crises. But this is complex stuff, and we're trying to muddle our way through things we haven't seen before. So, as I was saying before on housing, I have a view that obviously everyone wants my view on housing, and I'm happy to say that I think the market will flatline to maybe taper up to 5%. I definitely don't right now share the view that prices are going to go into free fall and plummet. 10% as CBA is saying, 20% as AMP is saying, or 30% as Louis is arguing. But I might be wrong. And certainly if our central case doesn't play out, which is a fairly benign and sanguine case, and we don't get a rapid exit from containment, and certainly if US and China relations completely blow up and we have a kinetic conflict akin to kind of some new form of World War III, then that'll be important new information, and we'll have to adjust accordingly. But at this point in time, I'm actually pretty bullish housing, and I'd be trying to fade any weakness in the next 6 months. If I was a buyer, I've bought. So, but if I had spare cash, I'd be fading the weakness. You can get, as an investor, you can get a 5 times levered exposure. You put a 20% deposit down, 80% leverage, and if house prices are going to increase, as I think they will, by another 10 to 20% this cycle, with a 4 to 5% rental yield gross after transaction costs, your returns could be incredible. Obviously, there's risks. I think it's going to be one thing that is interesting for the housing market. If we assume like 7 to 10% of all borrowers have taken these repayment holidays for 6 months, what does that mean? Like, how do they transition back, and how easy is that transition? And how does that interplay with, potentially we do see some stressed for selling in 6 months when they come off those repayment holidays. Yeah. That needs to be juxtaposed against the fact that the RBA has cut rates are lower. The banks have all been told to lend, they want to lend. All other asset classes look shite. Equities has been smashed, commercial property has been smashed, private equity has been smashed, hedge funds have been smashed. So, as a saver, and you can't get anything in cash. So as a saver, I think, resi property looks like a pretty attractive destination, but I could be wrong.
Fantastic, mate. Well, I'm sure everyone will they always tell me when I'm wrong on Twitter, so I'm sure they do the same to you, mate. Some of those people out there in Twitter land. But it's been fantastic. I hope you guys have appreciated Chris giving us his time, and we'll have to catch up again in the future.
Thanks, guys, and reach out anytime if you want to connect through Twitter.
Thanks, guys.